So welcome everyone. Last week we stopped right here at this point where we have a short discussion of how derivatives, financial derivatives, are dealt with under German accounting rules. Why should there be any specific rules when it comes to hedge accounting? I think I explained this to you last week. The reason for this is that, first of all, financial derivatives can be quite risky, and they can pose a substantial loss risk if the company is not competent enough to use derivatives, and if they are used improperly, they can pose a financial risk of losses to the company. So they're risky, that's one reason. The other reason is they are usually quite complex and it's not so easy to price them. So obviously when it comes to accounting, we need to fix the methods and the rules with which derivatives are priced. And last but not least, derivatives are usually used for either hedging or trading and speculation. Now, I told you that financial derivatives can be quite risky. However, if you use them for a hedging purpose, this means that you are trying to hedge a risk that is already on your balance sheet. For example, you have an interest-bearing position, like a loan, or a fixed income product, and you want to use an interest rate swap or an interest rate derivative to hedge this risk. Now, if you take the interest-bearing position, or if you take the derivative on its own, both can be quite risky. But in combination, the full position of the risk-bearing position plus the hedge instrument, the full risk of this total position will be very small or ideally even close to zero. So should this be reflected in your balance sheet? Well, this is where accounting rules differ. I told you last time that there is a substantial difference between accounting under US GAAP and under IFRS. And one of the major differences between these two accounting regimes is hedge accounting. That is, under US GAAP, netting and offsetting of derivatives is allowed, whereas under IFRS it is not allowed, making the difference between, for example, the balance sheet and the total assets of Deutsche Bank under US GAAP and under IFRS huge. The difference is actually, it's, I think, 1 trillion compared to almost 2 trillion. So it's virtually twice the size under IFRS. Okay, so keeping this in mind, we now have a short look at the accounting rules for hedge accounting. Derivatives. Under the German Commercial Code. Let's start with option rights. We have a call and a put, and we'll have a look at how these positions are dealt with and how these are accounted for at the point in time where the contract is concluded, where you have the valuation on the balance sheet date and when the option is settled or exercised. So when you enter the contract, you have the accounting of the option premium under other assets. That is, for a put, it's A15 as an asset. You have possible write-offs of the option premium to the lower stock market price if the option has decreased in value. And at the point in time where you exercise the option or where the contract is settled, you take the purchase price, which is the option premium plus the exercise price, and the sales revenue you get from the option contract is the exercise price minus the option premium. And these enter your income statement and your balance sheet. What is the option issuer position here for a call and for a put? You account for the option premium under other liabilities. That's P5 or P7C. And you have to report the initial margin under advances to customers, that is A4. You might be forced to create a provision for impending losses from pending transactions, in German Rückstellung bilden. And how do you calculate these provisions? You take the difference between the stock market price on the balance sheet date and the passivated option premium. Not very surprising. German commercial code is quite conservative and is very keen on usually taking the lowest price possible for an asset. And here it's not a big surprise that you have to mark to market the option positions just to be on the safe side. Again, at the point in time when you settle the option contract, you take the sales revenue, which in this case is the option premium plus the exercise price again, and the acquisition costs is the exercise price minus the option premium. Now for futures, it looks a little bit different. Does everyone know what the difference between an option and a future contract is? Everyone's clear on what a future contract is? Okay. When actually the same for a forward. If you buy a forward, you have to report the initial margin as advances to customers, and you put it on your asset side under A4. You might be forced to create a provision in the case you have impending losses from your future contract or forward contract. How do you calculate this provision? You take the difference between the forward rate at the balance sheet date and the agreed upon forward rate. This is quite natural because this difference reflects what you have currently lost on your forward or future contract if the contract were to be settled right now. And the acquisition costs is the agreed forward rate, and the revenue would also be the agreed forward rate. Because for a contract, if you buy or sell a future contract, just like an option, you need to know what are your acquisition costs, because this would be entered on your asset side of your balance sheet. Okay. So this is quite important for banks, obviously, because banks trade heavily in derivatives. And it then depends on whether you have a balance sheet under US GAAP, under German GAAP, under the German Commercial Code, or under IFRS. Now let's turn to the income statement. What does the income statement look? The structure and the layout of the income statement, these two are also regulated now in this executive order, die Verordnung über die Rechnungslegung der Kreditinstitute, executive order concerning the accounting of banks and financial institutions. In this case, Form 1 was the balance sheet, Forms 2 and 3 concern the income statement. Again, unlike non-banks and non-financial institutions, banks can choose between a single or a double column layout. In German, that's called Staffel oder Kontenform. And a classification is based on different possible criteria. For example, we have a separation of income and expenses from lending business and those from securities and financial services business. We have a separation or segregation of operating and value expenses, and also expenses and income into operational and non-operational components. What you will most likely see is that banks distinguish between income and non-income, interest and non-interest income. That's the way. Why? Traditional lending and deposit taking will cause interest income and interest expenses. They will earn interest on their loans granted, and they will have to pay interest on the deposits depositors have given the bank. That's the traditional commercial banking part of the bank's business, and that's the first part of the income statement: interest income and interest expenses. Then, next, you will have non-interest income and non-interest expenses, leading to non-interest net income. What is non-interest? Everything that is not related to interests, that is not related to the lending and deposit-taking part of the bank's business, aka financial services, but most importantly, investment banking. There is one current working paper out by Markus Brunnermeier from Princeton University, and the paper looks at the question whether investment banking was, for some reason, in part responsible for the severity of the financial crisis. And what the authors do is they look at a continuum, at a universe of US banks, and they want to measure how much was a given bank involved in investment banking. Now you cannot see, and you cannot directly see that, for example, Deutsche Bank has 70% of its business in investment banking and 30% in deposit taking. So what they do is they simply calculate the ratio of interest versus non-interest income. If the bank earns a lot of money and has a high income from interest business and interest-bearing products, it's a traditional commercial bank. If they earn all of their income in non-interest fees and commission, it's supposedly an investment bank. So if you ever see an income statement of a bank, interest and non-interest income will tell you a lot about the type of business model the bank is running. Okay. Now this is what it looks like under the German Commercial Code and the Verordnung zur Rechnungslegung der Kreditinstitute. You will see on the left-hand side interest expenses, provision expenses, that is non-interest expenses. And then at some point here under 4, for example, you see personnel, and you will have write-offs and corrections of the value of certain positions on the asset side. On the right-hand side, you see income, interest income, and you also see current income from securities, from companies this bank has a stake in, and under 4 you can see provisions and commission fees. Provisionserträge, commission fees, this is the part usually where you can see investment banking. This is not where you can see the small little fees that you have to pay on your balance, on your checkings account, but these are the commission fees the bank earns in investment banking. Okay, and so on and so on. And you can also see that you have write-offs, you have taxes, and at some point you will get a positive or a negative net income in total. Okay. Now, you can calculate the net interest income. You take the interest expense, you take the interest income, and the current income from shares, investments, and holdings. And if you take the difference, this will give you the net interest income. The net trading income is the net expense or income from financial transactions. That is A3 and A5 on the asset side of the balance sheet. You look at the realized gains, the appreciations, the depreciations in your assets, more precisely your security holdings. And this results from financial transactions in foreign exchange, securities, financial instruments, derivatives, etc. And then you will get the net trading income. You will also have gains and losses from other securities and receivables. This is mostly derivatives. Valuation result from the lending business, earnings from liquidity reserve securities, and here you will also have a netting option if you want to exercise it. Okay. Net income from investments. Similar to non-banks, on the right-hand side you have the income from appreciations on shareholdings, shares in associated companies and securities held as fixed assets. That is the investments in securities in other companies. This is the net income. You have realized gains and appreciations, and on the left-hand side you have the corresponding realized losses and depreciations. So if, for example, a bank buys stocks in Microsoft as a long-term investment and the stock price of Microsoft drops, they will have a depreciation on your investment. They might earn something from that investment, and the result will be the net income from investments. That's quite clear. So that's the income statement. It will look a little bit different from country to country, but in many countries you will see the basic differentiation between interest and non-interest income. And then last but not least, you will have the notes and a management report that are required under German law. Again, most of the information we've just seen, this is regulated by the executive order concerning the accounting of financial institutions. And in addition, the general rules of the German Commercial Code still apply. And the information to be included in the notes on management report, this type of information can be divided into three categories. First, you have information on the rules and methods that have been applied in accounting and valuation. So everything you've done to construct your balance sheet and your income statement, all those decisions need to be documented. Why? Because an auditor and the general public might need this type of information to understand how the bank has arrived at, for example, a certain value for a certain position. If they have some netting options, if they have some discretion when it comes to accounting, all those decisions and all those discretionary rules, they need to be described in the notes to the balance sheet. Further explanations of the balance sheet and income statement and disclosures on off-balance sheet transactions, that is forward and option transactions, as well as swaps that are not included or that do not need to be included in the balance sheet. There are some types of transactions that do not have to appear in the balance sheet and the income statement, but they should be included in the notes to the balance sheet. And with regard to the management report, there are no special regulations for banks, but you can observe that most large banks have arrived at a joint style of writing a management report. There's some peer pressure you can see from investors coming that forces banks to more or less report and write the management report in the same style. So you will always have a letter to the shareholders. You will see that management reports on certain aspects in risk management, and one has to see that there are several other laws that require all companies to report on certain aspects of their business. Does anyone know what needs to be disclosed by all banks starting at a certain size? First type of information that is mandatory is information on governance and executive compensation. You might remember that a couple of years ago, people and politicians were complaining about the high levels of compensation for top management. And at some point, a law was introduced that now forces large companies to disclose the compensation packages for managers. So if you want to know what the current CEO of Deutsche Bank earns, you can go to their corporate governance website or investor relations website, and you can see how much each member of the board has earned in 2017, 2016, and so on. This only applies to very large companies, but still it's mandatory for them. Then there's another law, German law, that requires information on risk management. That's the so-called Kontrakt. By the way, most German laws are abbreviated in this way. The G stands for Gesetz, law, and each law has a special abbreviation, even though the full name is actually often reversed. For example, this is the Gesetz zur Kontrolle und Transparenz im Unternehmensbereich, the law concerning control and transparency in the corporate world. Gesetz zur Kontrolle und Transparenz im Unternehmensbereich. It was introduced in the 90s, I think in 98, and it was this law that for the very first time required German companies to have risk management, and to have risk management proportional to the size of their business. Meaning that if you have a small family company here on High Street, this company will not be required to have its own risk management, because it would be disproportionate for a small company to even have risk management. But at some point, if you grow larger and larger, at some point the risks of your business will increase, and this law very generally requires you to think about risk management and to have a proportionate and appropriate risk management in place. Now, for banks and insurance companies, this wasn't a big surprise, but for industrial firms, this law, for the very first time in Germany, now requires companies to have a risk management report and to state their risks and to report on their risk and how they have dealt and managed their risks. And this is also part, of course, of the Jahresabschluss, of the annual statement of companies. This is mandatory. Everything else is voluntary. So they can report on some other things, but then this is rather a question of investor relations. Okay. Those are the notes and the management report. Then let's briefly talk about annual financial statements under IFRS. There are some major differences. If you are interested in this, I would recommend going to a lecture on international accounting rules and IFRS, but here we just stick to the major differences and the things that concern banks. Now, in addition to the balance sheet and income statement, the IFRS annual financial statements also include notes and a cash flow statement. The cash flow statement provides information on the change in the cash reserve of the bank. Financial instruments are significant for accounting and valuation purposes, including financial assets, obligations, and equity instruments. Financial instruments are divided into those held for trading, those held to maturity, and those held for liquidity. And the trading and liquidity portfolio is valued at fair value, while other assets and liabilities are valued at amortized costs. Now, what does this mean? This actually is a very small piece of information in a sentence on the far bottom of this slide, but one cannot stress enough the importance of fair value accounting under IFRS. This is one of the major differences between German commercial code and German GAAP and IFRS. Fair value accounting. What does it mean? What does fair value accounting mean? In very basic terms, if you buy an asset, if you buy, let's say, now let's make a very, very practical example. The university buys this beamer. It will insert this asset on its asset side of its balance sheet. It pays for this beamer, say 1,000 euros, and you would include this asset with a fictional value based on the amortized cost of 1,000 euros. So your asset side of your balance sheet will include assets, beamer, 1,000 euros. Now, as soon as we've bought this beamer, it will depreciate and it will lose in value. No one will be willing to pay 1,000 euros for an already installed and used beamer. Now the market price for this beamer, if I were to sell it on eBay, would probably be just 200 euros. Now what happens? Under the German commercial code, the beamer, in many cases, in many instances, can stay on the asset side with 1,000 euros at amortized cost. We will use depreciation, but we will assume that we will be using this beamer over the next 10 years, or say 5 years, and we can then use standardized depreciation rules, for example, linear depreciation, and next year we'll have 100 euros of depreciation, and it will be on our asset side with 900 euros, then 800 euros, and so on. Why? Because under the German commercial code, we will assume that we do not want to sell it, we want to use it. And if you only want to use it, if you want to use this asset, you can insert it and you can value this asset position at amortized cost and use depreciation rules. Now, what does fair value accounting mean? We buy it for 1,000 euros, we install it, and at this very moment, after installation, the market price, the current market price, would only be 200. And fair value accounting means that you have to market your positions to the fair value, that is the current market price. That's why it's called marking to market. You will have to use the fair value. The current fair value is 200, meaning you will have an immediate depreciation of 800 euros in your income statement. Does anyone know why this is done under IFRS? What's the advantage of fair value accounting and what the disadvantage can be? And why it has gained some notoriety during the financial crisis? Any ideas? What is the advantage? Now, it is assumed under IFRS that an income statement and a financial statement under IFRS gives a more realistic picture of the company. Why? Because we know if we were to sell it, this beamer, directly after installation, is no longer worth 1,000 euros. It has already depreciated. So let's reflect this in the financial statement. And if we make a more realistic example for a bank, this would not be a beamer, this would be a security. This would be a debt security, this would be a bond or a stock investment. Now, if we can observe a market price, and if we know the stock of Microsoft is only worth 10 euros, why should we leave it with 20 euros on our balance sheet? Insert it, mark it to market, and use 10 euros. This is the advantage that many people see, that financial statements under IFRS give a more realistic and accurate picture of the bank's or company's current financial situation. But what is the major disadvantage? The same thing we had in this example here. You buy this asset and you immediately have a sudden depreciation of 80% just because a market price has gone down. It might be that if we think of a stock investment, if we buy at 100, if the stock price goes down to 20 and then increases again after a couple of days, it might be that we are able to recover some or most of the losses we just experienced, but which haven't been realized. If we are not going to sell this asset right now, these will be fictional and these will be hypothetical and not realized gains or losses. But under IFRS, if you have an asset and the market price goes down, you will have an immediate depreciation. And this is what happened during the financial crisis. Many banks had asset portfolios with securitized loan portfolios and CDS and CDO-conned portfolios and investments. During the financial crisis, the market for these instruments completely broke down. It was highly illiquid and no one was willing to pay and buy these instruments and these products. So the current market price was zero. these financial products were worthless. IFRS fair value accounting forced banks to write off all of these investments. And at that point, many banks experienced huge losses on their balance sheet because they suddenly had to write off billions and billions in fair value assets on their balance sheet. A couple of years later, when banks were again willing to buy and sell CDOs and loan portfolios and securitized debt, etc., these products that previously were worthless suddenly again had a value. And obviously they didn't lose 100% on their investment. It might in some cases be that they only lost 10 to 20%. But these write-offs, these losses experienced due to fair value accounting had forced some of the banks already into bankruptcy way before they were able to recover the value on these assets. That is why fair value accounting is in part seen not as a cause but as an accelerator of the financial crisis, because it forced banks to report huge losses, and this made the crisis even worse. Okay. What's the legal basis for IFRS bank accounting? There are a number of so-called international accounting standards, IAS standards, that apply to the IFRS annual financial statements, and the following standards are particularly important for banks: IAS 30, IAS 32, 39, and 21. So 30 is the only bank-specific standard that regulates disclosure and reporting requirements for banks. 32 deals with disclosure and reporting obligations for financial instruments across all industries, but because banks heavily deal in financial instruments, this is of course also of major importance to banks. 39 acts across industries and contains rules on the accounting and valuation of financial instruments. And 21 regulates cross-industry currency conversion. If you have foreign exchange risk, this is also relevant for you. Now, what does the balance sheet look like according to IFRS? There are no form requirements like we've seen them under the German Commercial Code. However, there are some recommendations on minimum disclosures in the balance sheet. For example, IAS 30, number 19. And the number of items in the IFRS balance sheet is significantly lower than in a balance sheet under the German Commercial Code, because a lot of the information is relegated to the notes and the appendix. So this is what, for example, a minimum balance sheet under IFRS could look like. Again, you also have here equity, long-term debt, short-term debt, long-term assets and short-term assets, and balance sheet. It's much more condensed than under the German Commercial Code. Okay. Now, what is a financial instrument under IFRS? It's a contractual agreement which leads to a financial asset at one company and a financial obligation at another company. And you have financial assets like cash, receivables, bonds, option rights, and equity instruments of another company. You have financial liabilities, debt securities, loans taken, written options, and equity instruments. Those are shares, preference shares, and warrants. Okay. Again, the financial instruments are inserted into 4 categories. Financial instruments at fair value through profit or loss. Those are the trading assets and the trading liabilities. You have instruments that are held to maturity, like specific or determinable cash flows, fixed maturity, that are held to maturity, and you need the intention and the ability to hold a financial instrument to maturity. You have to mark this in your balance sheet. You have loans and receivables with no short-term intention to sale or trading. You're not able to designate it as a financial asset at fair value or available for sale. And some instruments are available for sale. So these are the instruments that have not been classified in one of the 3 previous categories. Those are available for sale. and this includes all equity instruments that are not financial assets at fair value. But you can see that most of them in the first category have to be marked to market if you have a market price. Okay, that's the valuation. Financial instruments are valued at the cost of acquisition, and the subsequent valuation is at fair value or amortized cost, depending on the category the financial instruments have been accounted in. Now, in the case of amortized cost, changes in value occur only if the asset is sold or if there are indications of impairment, so that an impairment loss has to be recognized in the income statement. Indications of impairment are an objective indication of a permanent impairment based on a past event after valuation, and if this event affects future cash flows. That is, if you have probable cause that your value, the value of your instrument, will stay low and stay at this decreased level, you will have an impairment loss. This is not a transitory change in value, but this is a permanent one, and then you have an impairment loss. This is caused by these two things. Now, on the asset side, you can see that the valuation standard is for loans and for those assets held to maturity at amortized cost. Those that are available for sale, you will have fair value accounting. Treatment of fair value changes, actually here for loans, obviously no change, because you don't have fair value accounting, but for the available for sale, you will have profit neutral treatment of fair value changes. Financial instruments at fair value, both on the asset and liability side, fair value, and these affect your income. No change on the liability side. Those are, the other liabilities are valued at amortized cost. And do you have an impairment test? Yes, yes, and here it's not applicable, obviously, by other liabilities. And here you have an implicit fair value test, impairment test through fair value accounting. Do you have a reversal of impairment? If this actually happens, this will affect net income here for loans and instruments held to maturity. For debt instruments, they will affect net income. And for equity instruments, these are profit neutral. Again, this reflects one difference between IFRS and German Commercial Code. The German Commercial Code is usually very pessimistic and very conservative, meaning that if it goes down, it stays low. It's very hard to get values and prices back in your asset on the asset side of your balance sheet, because if you're in doubt, German Commercial Code will force you to use the lower of two values just to be on the safe side for investors. IFRS is much more based on the idea of realistic reflection of the company's financial situation. Okay. The income statement is quite simple. Here, this is how it could look like for a bank. You have interest income minus interest expenses, interest surplus, fee and commission income, fee and commission expenses. That's the fee and commission surplus. Then you have trading income and trading expenses, and then the other expenses like, for example, personnel, rent, etc. And then you have earnings before taxes, then taxes, earnings after taxes, and then in the end you have the net profit or the net loss of the bank. Okay. In contrast to the German financial statement, you also need to have a cash flow statement. It provides information on the events that caused the change in the bank's cash reserve and provides an insight into the bank's liquidity situation. So you have annual net profit plus non-cash effective expenses minus non-cash effective income, and that's the net change in cash. And cash inflow and outflows can be divided into three sections. Now, cash flow from operating activities, from investment activities, and from financing activities. And these three make up the inflows and outflows of your bank's cash reserve. This will be part of your financial statement, and just like under German Commercial Code, you will also have some notes. They will be more extensive under IFRS than under the HGB. The notes include information about the group relationships. You will if you ever get to work with financial data on banks, you would see that you will have to make a different, you will have to distinguish between a bank and a banking group, or a so-called bank holding company. In the US, you will have a lot of banks, and these banks will be individual and independent entities from a legal standpoint. However, they will be full subsidiaries of a larger holding, and this is what we refer to as a bank holding company. Under US regulation, a company that owns at least one bank is considered to be a bank holding company, and then some certain regulations and laws apply to this company. So you will not have, for example, Citigroup or JP Morgan as one single institution. These will be bank holding companies, BHCs, and they will own hundreds and hundreds of subsidiaries all across the world, but most importantly, of course, in the US. Deutsche Bank, also the full holding structure of Deutsche Bank, I think, includes more than 1,000 individual companies that are fully owned by Deutsche Bank. So there is one Deutsche Bank AG, that's the what we in the US we would consider this to be the bank holding company, and Deutsche Bank AG owns hundreds and hundreds of subsidiaries. Now this is important because it is quite difficult, especially for supervisors, to see the full extent the bank is doing business in if you only look at the holding company. So you need to have information, especially as a supervisor, you need to have information on the group structure. Why? It is important to see, for the supervisor at least, to see where the bank is doing business, where the risks lie, where liquidity goes in and goes out, and where also some problems might arise. And for banks, these group relationships and these holding structures are extremely complex. So IFRS, not surprisingly, requires information about the group relationships and ideally also concerning the holding structure to give investors at least a glimpse of what the holding structure looks like. The full picture will only be available to regulators and supervisors, but still the notes will include some information on that. The notes to the balance sheet and income statement will also include a representation of the accounting methods, a breakdown of remaining terms, detailed information about the composition and valuations of individual balance sheet items. More or less, the notes will include a footnote to each and every item on the balance sheet and income statement. So you will have interest income, and there will be a footnote in the notes, and you will see how the bank has arrived at this specific number for interest income and some additional calculations, etc. If you want to know how this looks like, simply pull up an IFRS financial statement from any bank, and you will see how this looks like. Also, detailed information about the individual expense or income items in the income statement. The income statement will be very condensed. Even for Deutsche Bank, it will fit onto one page of and one sheet of paper. However, the notes, how the specific items on your income statement have been calculated, the notes will be 50, 60, 70 pages long, because all those very condensed high-level items will be explained in the notes. An explanation of the objectives and strategies of the risk management function of the bank. This is the risk report that is also mandatory under German law, but this is part of the IFRS financial statement. and also required by US supervisors under US banking regulation rules. However, I guess it's a good point here to explain how this looks in the US. Obviously, this IFRS accounting is not really relevant for US banks. US banks will have their financial statements done under US GAAP, generally accepted accounting principles, US GAAP. But they will also publish what is called a call report. Now, in many cases, your financial statement, just like with any non-financial company, will be directed at investors, stakeholders. However, banks also, of course, need to file a report with the responsible supervisory agency. Same in Germany. The only difference is in the US, these regulatory reports are published and need to be disclosed, and you can download them, for example, from the Fed. You can have, if you simply go to Google and you can download, you can simply search for call report 2016 JP Morgan, and you will be able to download the call report of JP Morgan for 2016. I think probably with the Fed, with the Federal Reserve. And you can see slight differences between the financial statement and the call report. Why? Because obviously the call report is directed at regulators and supervisors, and they will ask for some slightly different information than is required under US GAAP, and that is required under IFRS, for example, for European banks. Okay. But risk management, and this is why I mentioned this here, risk management is also an important part of the call report because, well, supervisors are concerned about bank risks and financial risks, and they want to hear and see something about the risk management done by the bank. We have a segment report which breaks down the income, expenses, assets, and liabilities according to business and geographic segments, information about events after the balance sheet date, and information about contingencies and other obligations. That's part of the notes. Okay, very small and very short basic description of IFRS accounting. Do you have any questions concerning the accounting of banks? One has to be honest here that one could also offer a full lecture on bank accounting. It is also important to see that if you ever want to work for a bank, you need to have a good knowledge of accounting rules. This is something that is usually missed out in, I would say, too academic and too research-oriented lectures on banking. I mean, we can do a whole lecture on financial intermediation theory, we can work on the diamond model, the diamond-Dybvig model, all extensions, and we can concentrate on banking theory, and we would have an economics class on financial economics that is completely based on theory and has nothing to do with the practice of banking. Now, if you ever start working for a bank, you will realize from day one that you need to have to keep in mind how everything and anything you do within the bank has an influence, has an impact on the balance sheet and income statement of the bank. And you need to know the basic rules for bank accounting. And the same applies actually the same applies to insurance companies. I still remember one executive of a large German insurance company when asked, what do you expect from university graduates and what would you hope for to see more in university graduates, the first and only thing he said, actually he was a mathematician, the first thing he said was, I would like to see more knowledge in accounting in university graduates, because everything we do here, when we price an insurance contract, when we calculate a premium, you can calculate everything. You can do anything you like, but people need to know what impact does it have on the balance sheet, on the income statement, and in many cases on capital. And you need also to know the regulation rules. Okay, we'll come to regulation in 2 sections, but now I want to talk about risk management. Why risk management? Well, we have seen that banks face a lot of risk. What risk do banks face? First of all, what do banks do? They grant loans, and loans are exposed to credit risk. You will have credit risk. If they buy securities or sell securities, they will have market price risks. If they own a large headquarters, that could be subject to the risk of a fire breaking out, you will have what we call operational risk. And these are the major types of risk we'll shortly talk about. If you're interested in this in more detail, I'll have the financial risk management class next semester in the summer again. We'll talk about risk management for a whole semester. Here I will only give you the beautiful nuggets of information from the lecture. First of all, when talking about risk management, we need to have a common understanding of what risk is. This is a highly philosophical question. You can speak of risk meaning in the sense of Knightian uncertainty, that risk is you do not know what happened, what could happen. That's Knightian uncertainty. Knight, like the white knight from fairy tales, because the researcher who thought about this was named Knight. Well, in this class, in almost all classes we have here in banking and finance, risk is understood, first of all, as financial risk. We are not interested in reputation risk, in the risk of your business going out of business, of your company going out of business because you're not able to sell enough pizzas, but we talk about financial losses. You have a position, you have an investment, or entered some type of contract, and because of this contractual obligation, because of your investment, you might suffer a financial loss at some point in time. So we concentrate on financial losses. These are perceived as risk. Uncertainty could be risk. Uncertainty about the occurrence of possible environmental conditions, and as a result, uncertainty concerning specific business goals. Okay. The deviation of a parameter from its expected target value, that could also be risk. In this and any other class, it's always a random negative deviation of financial variable from previously defined reference values of asset positions, meaning usually just financial losses. We are not too philosophical in this class or in the financial risk management class. Risk is the possibility of a financial loss. Why? Because this is what we can manage. We cannot manage uncertainty that we will win the lottery or that we will have bad business in the next month. We can only competently manage risk understood as the possibility of financial losses. So what are some characteristics of risk? It's random. It's a negative deviation, chance versus risk. One could also argue that, for example, if we start at 0 and we have the possibility of -5 or +3, each with 50% probability, one could argue, well, this is also risk. This is a positive deviation from what we would expect. This is where it gets philosophical and also quite practical. I have some examples that can show you that even positive deviations can be seen as a source of risk. However, usually negative deviations, that's risk. Financial, we only consider financial risk, and ideally risk is measurable. You can measure it. 2 examples that will highlight this difference between positive and negative deviations from a previously defined target value. The first example is the fall of Barings Bank. Does anyone remember Barings Bank? Probably not. Barings Bank was a British investment bank founded in the 18th century, so one of the rather old and traditional investment banks in the UK. In 95, it went bankrupt almost overnight. Why? They had a rogue trader called Nick Leeson, not Liam Neeson, but Nick Leeson. He was a rogue trader, and he single-handedly caused a loss of, as you can see, 1.5 billion US dollars over a couple of months. What did he do? He kept two accounts. He traded, and he kept the profits on the one account and the losses in a separate account. And he only reported the account with all the profits to his superiors. They were quite amazed and happy with his performance. They promoted him, I think, up to the position of chief derivatives trader in Singapore. And he traded, and he traded, and he traded, and he kept all his losses in one account. He hid this account, and he was able to do so because markets were not too volatile. And then what happened? Something happened that he couldn't anticipate. The 95 Great Hanshin earthquake. The Great Hanshin earthquake in Japan. Hanshin, that's the name for the region of Kobe and Osaka. The Hanshin earthquake killed almost, I think, 3,000 people. And it was a huge disaster in Japan. And some of you might have seen this. There are some horrible pictures and videos from that earthquake where also motorways collapsed. Because in Japan, most motorways are built just like in the US on pillars, and because at that point they realized that construction companies didn't stick to construction rules, the pillars collapsed and all the motorways collapsed, and they just collapsed to the side. And there were some fires, and almost 3,000 people died in that earthquake, and that caused Asian markets to plummet extremely, and that's when an Asian crisis started. When all markets went down, Nick Leeson was no longer able to hide his losses, and what did he do? He packed his suitcase and tried to flee the country. He was arrested at Frankfurt Airport and extradited to the UK and had to go to prison. The bank, however, because this was the bank's fault, the bank was bankrupt and it wasn't bailed out. So Barings Bank collapsed overnight. The second example is the case of Bernie Madoff. You might remember him. Bernie Madoff is infamous for being the inventor of the largest Ponzi scheme in the US, in the history of the US. Does everyone know what a Ponzi scheme is? In German, it's called illegales Schneeballsystem. It's a system, it's a scheme, and a Ponzi scheme is always illegal. In the US, you do not have this differentiation between legal and illegal Ponzi scheme, but Ponzi scheme is illegal, usually. Ponzi scheme is the idea that, for example, I could start a Ponzi scheme right now here, and I would tell you I have an investment fund, and I will guarantee you at least 5% return. I will get, let's say, 1 million euros from you, and I will have to pay 5 or 6% on my, I don't promise anything, I just tell you I'm expecting 5% return. Next year, I will pay out 10% to each of you. 10%, and at the same time, I will report this 10%, and another set of students will come to me and say, wow, you're paying out 10% return. Here are another 10 million euros, and another set of people will invest in my fund. Now, have I invested the money? No. I will pay out to you, the previous investors, the return of 10% out of the 10 million euros, the next set of investors has invested in my fund. I'm not doing any actual business. I'm simply using money given to me as an investment to pay out previous investors. And you can see the fund has now increased from 1 million to 11 million. Next year, I will pay you and the second set with the money I'm able to get from investors in the third round and in the fourth round and so on. And you can see why this is called a snowball system in German, because it starts tiny and it grows in size like a snowball. There are some cases where this can actually be legal. For example, in insurance business, you have these legal snowball systems. For example, when you want to try to sell insurance contracts. In German, we call this Strukturvertrieb. That means that you have a level of associate insurance business people, insurance marketers, and you have senior associates and executive salesmen and so on. And the system is that you have people that will get small commissions on each insurance contract sold, but a part of that commission will also be sold and will also be paid out to the next level and the next level and the next level. And this is a legal pyramid system, or well, it would be a Ponzi scheme, that is used to sell insurance contracts. This is legal. The Ponzi scheme, especially the one by Bernie Madoff, is illegal, highly illegal, because this is investor fraud. And he did this on a very large scale. As you can see, the damage to investors was almost $65 billion. Everyone lost money. The list of people that lost money is a who is who, for example, in Hollywood. Everyone lost money, starting with Steven Spielberg and going down to some other famous people. They each lost, say, a couple of 100,000 or 1 million, but was highly influential. And again, the Ponzi scheme worked just like any traditional and like any other Ponzi scheme. You take money from investors, you pay out previous investors by the inflows to your fund, and you do not do anything. And this works as long as everyone wants to keep the investment in the fund and you get new investments. During the financial crisis, however, and this is the event that happened here, during the financial crisis, everyone wanted their money back. And there was no money left. So Bernie Madoff went to prison. Statement of a whistleblower. But the biggest tip of a fraud was that Madoff reported his fund was down only 3 months out of 87, whereas the S&P 500 as the leading market index was down 28 months out of 87. Why did I bring these two examples? To show you that if something is too good to be true, this might also be an indication of risk. Do not always look at financial losses, but if you think that something is too good to be true, a high return with supposedly no risk at all, there should be a risk. It might be that it's legal, it might also be that it's simply investor fraud. Yeah? So in many cases, we just look at financial losses, but these two very prominent examples show you that you might also want to look at those positive deviations if something's too good to be true. Okay. Now let's turn to the question, how should we measure financial risk? This is an extract from DataStream. It's the S&P 500 Composite Index between 1995 and 2015. And you can see that you will have ups and downs, and this is a price index. So this is the price of the index. Could also be the price of a stock, but should we use a price? Could be an indication. We could use returns. We could use the volatility. In the case of the S&P 500, this is very convenient because you can immediately look at the volatility index that is traded on the S&P 500. This is called the VIX. This is the volatility index on the S&P 500. How does it work? Quite simple. If volatility goes down, if you invest in the VIX, if volatility goes up, you will profit from this. If it goes down, you will lose. So you will invest in the volatility of the index. You can use volatility. Disadvantage of volatility is that it will show you positive and negative deviations. So this is a price index. Okay, you can use negative deviations. This is a plot of the continuous log returns of the S&P 500. And you can see that on some days you will have -5, -2, in some cases you have -10%. What can you immediately see? What is this? The financial crisis. A single day loss of 10% is something huge. If the index loses 10% on one single trading day, this is a crash. One would think that a crash means a stock going down 70, 80%, but this is the S&P 500. So the average loss of any stock on the S&P 500 was on average -10%. And this was the largest crash during the financial crisis. By the way, you can also see that there are some other events here. That's the Asian crisis and the LTCM crisis in the 90s. You can probably also see, I would assume that this is 9/11. And you can see some major events here. You can also use absolute returns. Absolute returns, just in the way volatility shows you positive and negative deviations, absolute returns could also be used. It looks very similar to volatility. Again, here, this phase of high market volatility is a financial crisis. And then you can also use log returns below the 5% quantile or below the 10% quantile. You can see a slight difference here. If you're only interested in the very extreme losses, then you will take the 5% quantile, or you can use the 10% quantile. If you want to have a look at the positive deviations, you can look at log returns above the 90% or the 95% quantile. It's up to you. And these are just some examples to show you how difficult actually it is to agree on one common measure and one good proxy of risk. We'll see some risk measures later on, but this is thought of as a motivation for our later discussion. Now let's define risk management. Risk management is understood as the sum of all measures for the specific identification, measurement, management and control of risk in the company and the environment relevant to the firm. Its primary goal is shareholder maximization or stabilization. In the end, risk management, just like any other management tool, only has one primary goal: stabilize, or even better, maximize shareholder value. Otherwise, this will be value destroying, and why should management care? Risk management is a continuous process. You cannot simply do it once and then leave it, but you have to do it over and over again, because business is also fluctuating and business is time varying. It's a central management task. You cannot delegate it in many cases, but only theoretically. You cannot outsource it like a call center. Risk management has to be done by the top management, and it cannot be delegated. What's the risk management process? The risk management process basically is the idea that you start by identifying risks, you measure it, you manage it, and you disclose it, you control risk, and backtest it, and then start over. So to do a practical example, There is a beamer hanging above this from the ceiling here. This beamer could fall down. It could fall down on one of you. This is what we will later refer to as an operational risk. The risk that personnel is harmed, that you have an accident. I've identified this. There might be other risks. For example, there could be the risk of a fire breaking out. And if we think of, let's assume for a moment that we were a private university. A private university would mean we need this room in order to generate tuition fees. You would have to pay tuition fees. The university, if it were private, would be a company, and income would be generated from tuition fees. If there is a fire, if we do not have a seminar room, how should we attract new students? How should we generate income and revenues? So there's a financial risk to it. We have the danger, the risk of a fire breaking out. It could be a financial loss to us because then we could not get new students and we would lose revenues. So what do we need to do? We have to manage this risk. There are some strategies available to us to manage this type of risk. What would the usual way be to how to manage this risk? You can see this. Fire detectors. Done. Yeah? Maybe buy fire insurance, and the fire insurance will pay the rent for an auxiliary room that we would need to rent in case this room was not usable. And then you need to control it and you need to disclose it. You will need to aggregate this information and tell investors and stakeholders and management about this. Risk management, the risk management department will tell its chief executive officers, we have a fire break, but we have it under control. We have measures in place that manage this type of risk, and you do not need to care about this. And you need to make sure that you are dealing with this risk in the most efficient and shareholder value maximizing way. So for example, one would think that a fire detector and a water system here and a fire extinguisher system might be cheaper than simply say, oh, let the building burn down, we have fire insurance. Probably the insurance company will also ask you to install fire detectors. But you have two different strategies here. Simply accept the risk and buy insurance, or try to minimize the risk by installing a fire extinguishing system. Both will come at a cost. The insurance contract will cost you money, and the installation of fire extinguishers will also cost a certain amount of money. And you need to control this, and you need to assess the best way of managing risk. And then you will communicate it to your stakeholders, and then after 1 year, after 2 years, you will have to do this again and again and again. Do we still have the same risk? Do we need to do something about it? Has the premium for the fire insurance changed? Yes or no? And you will redo your decision. Now actually, I probably have told you all what is now written on the next couple of slides. First, when it comes to identification, you need to have an open mind. In many cases, this seems to be trivial. Yeah? We have a building, there could be a fire. We have a beamer, it could fall down. But think again, in many cases, highly trained professionals in industries that are known to have excellent risk management will lose sight of certain risks. My favorite, well, not my favorite, but I think a very good example to highlight, to showcase this, is the Fukushima Daiichi nuclear catastrophe. Everyone in Japan knows, yes, if you build a nuclear plant, make it bomb-proof and make it earthquake-proof. It needs to withstand an earthquake because Japan is known to suffer from frequent earthquakes. You need to build it next to an ocean or next to a river because nuclear power plants need water for their cooling system. Well, they didn't think about the earthquake happening in the ocean, causing a tsunami that crashed the nuclear power plant. A very simple idea. Now after this has happened once, everyone knows that this is a risk. But the very simple idea that the nuclear power plant could not be saved from a tsunami wave didn't occur to engineers and risk managers in an industry where everyone is concerned about risk. No? So risk identification is not as trivial as one might think. Also, this is also very important in operational risk management, in op risk. I know of an insurance company with its headquarters in, I will not say the name of the city, then it would be clear which insurance company it is. Needless to say, it suffices to say that the headquarters of this insurance company is only 3 kilometers away from a large chemical plant. And this insurance company has an emergency plan in place. What happens if there is an explosion or an accident at this chemical plant? Because they are producing paint, and paint is known, and the production of paint is known to cause dangerous fumes. And if there is a cloud of poisonous fumes coming into the direction and being blown into the direction of your insurance company headquarters, you need to evacuate. And this company has an emergency plan in place how to deal with such a situation, how to keep the IT running, where the people can work again. Do they stay at home? Can they work from their homes? And how can the business be run at least a minimal level to keep going until it is safe to enter the headquarters again? And this is also part of risk identification. You need to think about internal and external sources of risk that might affect your business. Risk measurement. You need to measure risk, and this is usually done in quantitative risk management. You need to know what is your position worth, how can market prices, how can default rates, how can interest rates, how can probabilities change, and then you need to put a price tag on your risk. What is the potential financial loss stemming from this risk? Sometimes you also use qualitative risk management, expert judgments, and so on, but ideally you can use quantitative risk management. Then you need to manage risk. You can completely avoid it, for example, by not closing a deal. Some companies do this for risk management purpose, or sometimes for even more ridiculous reasons. I know many energy companies think about entering derivatives contracts and to trade with derivatives. However, first of all, these derivatives come with a certain amount of risk. So the easiest way to manage this risk is just to say, I don't do this at all. I will not enter a derivative contract, period. Complete avoidance. The funny thing about this is many energy companies exactly do this, but for another reason. They do not enter derivatives contracts, not because they are risky, but because regulation is so tough on them that they just say the benefit of using derivatives, for example, in risk management, are completely offset by the regulatory costs. They need to fill out so many forms with regulatory and supervisory agencies. They just say, no, let's not do this. Let's avoid this hassle. Reduce the risk. You can enter a hedge contract. We'll later on see this, but you can use a derivative, and by combining a position with a derivative, you will have a hedged position and risk will be reduced. You can transfer the risk. Fire risk by insurance, then the risk is transferred to the insurance company. Or you can mitigate risk, for example, by setting up limits. If you are a trader in the derivatives office, I can simply install a limit and say you are only allowed to have an open position up to 1 million euros. Everything beyond that has to be closed immediately at the end of business. And you have a trading limit, and you can mitigate your risk to some extent. Risk control, you have to review the identified risk. Is it really a risk that this beamer could fall down, yes or no? And then you have to assess and review your methods. If you can see that your methods are not appropriate, do other ones. Use other methods. If necessary, improve on them. And it must always be checked whether the benefits of the measures taken justify the costs. Just like with the example of the fire insurance versus fire extinguishers. That's risk control. And last part is you need to communicate and inform all relevant stakeholders. The managing board, the supervisory board, supervisory authorities, auditors, public accountants, actuaries in insurance companies, and so on. Everyone who needs to know about risk management needs to be informed and needs to be informed about the methods used, the risks identified. And if you pull up a risk report from a bank from the internet, you will see what type of information they provide you with. This is the risk management process. And again, it's a continuous process. You have to do this again and again and again. And all banks, I presume, will have a risk management department. Okay. Risk types. I think we'll stop here. I should not punish you for the short presentation of IFRS today. Have a look at the risk types. I've already mentioned the most important ones. They are market risks, credit risk, and op risk. Why? Because first of all, these are the most important categories of risk a bank faces and is exposed to. And also this is due to regulation. In the 2000s, the Basel Committee on Banking Regulation and Supervision, based in Basel in Switzerland with the Bank for International Settlements, came up with what is now referred to as Basel II, Basel II. A set of regulations and an initiative to standardize and harmonize regulation of banks across the globe in the world, especially in the European Union. And Basel II set out common standards, especially how to calculate regulatory capital. And what they did is they said, let's put all bank risk into 3 categories: market risk, credit risk, and everything else, which we now define as so-called operational risk, op risk. Operational risk is somewhat a residual category to market and credit risk, but Basel II is the starting point when banks started to categorize all of their risks into these 3 categories. Market risk, everything that is all risks that are caused due to changes in relevant market prices. And market prices can be interest rates, foreign exchange rates, currencies, securities prices. Then you have credit risk. Every time someone else owes you money and cannot pay up, that's credit risk. And this is important to know because this also affects industrial companies. If you take, for example, this pharmacy, if you were able to buy on credit, if you can simply go to the store and say, I want to buy this perfume, I will pay you later, and you take the perfume, use it, and later tell the perfume store, oh, sorry, I cannot pay up, the perfume store also faces credit risk. It's sometimes referred to as debtor risk or counterparty risk, but every industrial firm that sells on credit also faces credit risk, not just banks. And then you have op risk, and op risk is usually defined by legal risks, IT risk, and the risk that employees act illegally. Okay, and we'll talk about these risk types, I guess, 2 weeks, because next week we'll have a guest lecture. Yeah? I think next week, but I'll probably send around a couple of notification emails before that. Okay. Any questions? If not, thank you for your attention and see you next week. Thank you.